Hey everyone, you're watching my daily trade log. I document one of my option trades every single day for your benefit so you can learn from it. And today is my trade number 230. I have almost completed one full year. And obviously, once I completed one full year, then I will share my results of the documented trades. But before I talk about that one, I wanted to share with you a quick analysis that I did on coffee versus investments. So let's assume that a coffee costs $5. In many parts of the world, a cup of coffee nowadays actually costs more than $5, but let's not talk about that. So I wanted to demonstrate to you what would happen if instead of you spending $5, if you're a coffee drinker, if instead of spending $5 every single day on a cup of coffee, you invested it into the stock market. And so I used very conservative papers. I used ETFs and I used the SPY, which is the S&P 500, and I used the SPY-D, which is the high dividend yielding stock portfolio. So both of these are very safe and secure investments. Obviously, when it comes to the stock market and every other investment, there's always risk. There's always risk of losing. So let's talk about what $5 would get you on the stock market if you invested into the SPY. Now, one thing to keep in mind is that the blue line shows the SPY stock price. So in order to get your first share, you need to wait a fair bit because you only invest $5. So by the time you get to 300, it will take a bit of time. I looked at a 5-year time frame because most people can't think longer than 5 years, and that's not exactly something that I agree with. You have to be able to think much longer term. You have to be able to think 10, 15, 20 years ahead, and that's how you can really make the right decision. That's how you can build up your wealth and make the right strategic moves. So the red line shows the cash that you invested into the market. As we can see over here, there's a little bit of a dip. So this is where probably you started buying your first stock, and then every single day you just add $5 to it. Of course, the market crash around the pandemic affected your portfolio, and after that you see your portfolio going up through the roof. And after 5 years, your portfolio would be worth over $11,000. So think about this. You invest $5 every single day, and all you do is you just keep buying SPY once you have enough cash. And after 5 years, your portfolio is sitting at over $11,000. So that's not a bad result. Now let's take a look at SPYD, which is a dividend heavy ETF. ETF, for those of you who don't know what an ETF is, ETF is basically just a paper that tracks certain companies, a bucket of companies, or other indices. So if you invested $5 into SPYD, which is much cheaper, it normally trades between 35 and 45, so it's much easier to get your first stock, and obviously the dividend yield is much higher than in the case of SPY. So now let's compare the two together. So over here you can see the blue line indicating the SPY and the red line indicating the SPY-D. So once again, this is the wealth that you accumulated over 5 years. As you can see, the performance is very similar. If we zoom into the last 12 months or so, we can see that the SPY-D is a little bit above. And finally, let's take a look at what would happen if you invested into SPY-D versus just chucking $5 under your pillow every single day. So the blue line indicates your pillow and the red line indicates your SPY-D position. So you can see that you would be much better off. You would be sitting at 11,300 after 5 years versus 8,900. So there's a bit of difference. And it's also worth keeping in mind that this is a very short time frame when it comes to investments. If I looked at this analysis over a 10-year period, then the gap would be much larger because of the exponential growth. Now, let's take a look at a situation. If you invested, let's say, $10 every single day, then in the case of SPY, your portfolio would be worth over $22,000. In the case of SPY-D, it would be worth over $23,000. So I'd like you to process this. I'd like you to, next time when you go out and entertain yourself and you spend $5 here, $10 there, then think about this, that if you just put that money, that tiny little cash, into an investment, then you can grow your wealth quite nicely. And we're talking about very little money in here. Obviously, if you invested a lot more every single day, let's say $50 every day, then after 5 years, you would have more than $100,000 in your trading account. Another thing that I will reveal in another video is how you can boost your yield on these investments. So instead of just relying on the dividends, the SPY dividend is something like 1.7. You can check it on yahoo.com. And the SPY-D is much higher. That's close to 5%. But you can also beef up your yield by selling call options against your positions. Once you have 100 shares of a company or an ETF, then you can sell a call option against it, and this is called a covered call. And that's a beautiful strategy to increase your yield and collect additional cash every single month. Unfortunately, you can't really do that on the SPY-D because the share price is very low and the fluctuation is quite minimal, so the option prices are very low as well, so it's not really worth it. But you can certainly do that in the case of SPY. So it will be a very exciting analysis to see how SPY would perform against SPY-D in exactly the same situation, but beefing up SPY by selling call options. So stay tuned to that. That video will come in the near future. But for now, let's jump over to my trade number 230. I traded IBM. IBM had earnings after the close today, and I wanted to take advantage of the higher volatility. As we can see over here, this is the option chain, and the options that expire in 2 days, they have a 67.3% volatility versus 26.9% in April. So what I did is I sold a 135 put option expiring in January 27th, and I also purchased the same strike price, the 135, expiring in April, and that cost me $3.61, or in other words $361. So that's my absolute maximum loss. But it is very, very unlikely that I will lose $361 on this deal, because if something goes against me, I can always just roll my short position, which is the January 27th position. I can always roll it every single week, or I can roll it to February, and then I can roll it to March, and then I can roll it to April and collect additional premium and reduce my cost basis. Another thing to keep in mind is that April 21 is most likely going to be after the next earnings. So this IV of 26.9% is going to go up. So I'm going to have two opposing forces in here pushing and pulling the option values. And what I can expect is that the April 21 options will retain most of their values. And that's good for me, because what I'm banking on is that my January 27 position will lose its value and my April position will retain its value. So if we go over to the trading platform that I use, then we can see that the 135 put option is trading around 0.82. So I collected $83 roughly. And if the value of that goes down to zero, then I will keep that $80 odd. And what I am hoping for is that my April position, which is my long position, so this is something that I purchased, is not going to lose. $80 in value. So if it loses, let's say $40 in value, then I will pocket the difference. I will make $40 on this trade. So that's exactly how you can take advantage of the different volatilities, and we can most likely find out tomorrow how this trade turned out. So keep tuning in. I hope you find this useful. I hope you find this beneficial, and don't forget these charts when you buy your coffee next time. And please hit the like button, subscribe to my channel, and spread the word. Thank you for watching.